Welcome to Velocity Banking in 6 minutes. So today we're going to talk about interest. What is interest? And how can you take advantage of interest rates? So before we get started, if you already haven't done so, head over to our website, myvelocitybanking.com, sign up for a free account. Put in your interest. Put in your income. Put in your expenses. Put in the debts you're trying to pay and get a payoff chart. Print out this chart. You follow it as much as you can, and you'll be out of debt in zero time. So today, like I said, we're going to talk about interest. So we're going to get right into it. What is interest? Interest is something you're either earning or you're paying in any financial transaction and especially when you're doing velocity banking. So interest is sort of like the baseline motivation when doing velocity banking, because you're trying to pay as little interest as possible. You're trying to squeeze by the little interest as possible, because the less interest you pay, the more you have. The more you have, the more cash flow you have. The more cash flow you have, the more chunk payments you have, and so on and so forth, the sooner you can get out of debt. So we're going to try and pay as little interest as possible. So before we get started, I'm going to give you guys a pop quiz. We got Sarah. She wants to buy furniture. She's bought a new house. She wants to furnish it. She needs $2,000 for the furniture. She goes to the bank. Bank number one says, from Sarah, I'm going to give you $2,200. You pay us back in a year. Sarah says, all right, cool. Now she goes to bank number two. Bank number two says, fine, we're going to give you that $2,000 that you're asking for, but we're going to charge you 7% interest for a year. You got to pay us back in a year as well. Sarah says, okay. So she thinks about it. If you're Sarah, would you go with bank number one, $2,200 up front, pay back in a year? Bank number two, $2,000 up front, 7% interest rate, you pay us back in a year. Which option would you take? Now stick around to the end of the video, because I'm going to tell you what the right answer is. So let's get back to interest. Like I said before, interest is something that you'll always either pay or earn when doing any kind of financial transaction. So how do you calculate interest? This formula. I, which is interest, is equal to P RT. P is the principal. That's how much you're borrowing. R is the interest rate in decimal format times T, which is the time. In this case, in Sarah's case, it's only a year. So that's how you calculate interest. So before we get into that, we see and we walk it through, I've got another interesting interest story for you. My MBNA credit card. I did a video a while ago about taking advantage of balance transfers. And one caveat I had in there is that if you miss a payment, the interest rate goes from 0% to the regular interest rate that the banks charge or your credit card company charges. Now, guess what? I slipped up. I missed a payment. I missed a payment around Christmas time, and I thought I had auto pay on. I didn't have auto pay on. I missed a payment, and guess what? Now my interest rate has gone. You guys can't see it, but now it's gone from 0% to 12.99%. 12.99% on this MBNA credit card that I have. So I'm thinking to myself, Mr. Velocity Banking, knowing a lot about interest, how do I take advantage of interest and take advantage of the banks, that I have a plan to get this 12.99% on this 12,000-ish that I have on this credit card back to 0%. So here's how it's going to work, and this is why it's important to understand how interest works. So here's what I'm going to do. 12.99% is what I'm paying on this MBNA card. On my line of credit, I have a line of credit where it's only about 4%. So here's what I'm going to do. I'm going to pay off this card, 12.99%, with my line of credit, 4%. So we're going to zero out this card, and it's going to go back to my credit limit, which is, I think it's about $19,000 on this card. Right? So what we're doing, moving the debts around because we're trying to minimize interest wherever possible. So I'm going to move this MBNA to my line of credit. There's no more balance on this MBNA card. Now the balance is sitting on my line of credit at 4%. Now, here's where the magic comes in, and here's where you guys need to figure out how to take advantage of the banks to help you get out of debt faster. Now, here's what's happening. Now, MBNA is offering a 0% offer again, right? So a 0% balance transfer again. So guess what I'm going to do? Now that I've got that 12,000 zeroed out on this, I'm going to do a balance transfer of 12,000 again. When I get the 12,000 into my account, I'm going to take that to pay off my line of credit. So now all that 12,000 is back on MBNA, but this time it's at 0%, not at the 12.99%. So using that financial jujitsu, we have converted 12.99% to 0% again. Now, technically, you're not paying 0% because there's a 3% fee. But the point still remains that we're not paying 12.99% anymore. We're going to be paying 0% for a year. And this time I have auto pay on, so I'm not going to fall into the trap of getting 12.99, the interest rate jacked up on me. So that's why it's important, like I said before, to understand how interest rate works, because you can look for all these little loopholes and ways to minimize the interest you pay. So let's get back to Sarah. Let's wrap it up. So Sarah, so we plug everything into the formula and we see that bank number 2 has the best offer for Sarah. That's because bank number 1, she's going to end up paying $2,200. Bank number 2, she ends up paying $2,149, which is clearly a better deal for Sarah. So that's it for interest rate. Make sure you like this video. Make sure you subscribe to this channel and hit the notification bell, because there's going to be a lot more videos about how to get out of debt faster using the Velocity banking method. All right, until next time.